Hey everybody, welcome. This is Lawrence Bensdorp in Trading Mastery School. And in this video, I would like to show you a long-term trend following system with a slightly different touch as far as the exits. And I think it's important that you see how this works because it's actually up for this year. And that is, of course, strange because long-term trend following systems on stocks, they should be down this year. It's very rare to keep systems and make profits when the markets are down. I mean, right now the S&P 500 is down about 17%. We're talking here October 24th, and the Nasdaq is down even more than that. So I was pleasantly surprised to see this specific system actually to be up for the year. And as you know, I am a big fan of trading a lot of multiple non-correlated systems, but also diversified systems as well. And with trend following on stocks, I think there's one way how you can diversify is by looking at different time frames, but also at different kind of exits. So let's get into the software. I'm going to share my screen and let me explain how this system works. So here we are inside of the software. And as you see, here are the results of this S&P 500 monthly rotation system. And what you see here in 2022, that we're actually up 14% for the year versus minus 16% of the benchmark. Now, I think that is quite astonishing. Let's go up over here and let's take a look at the equity curve. And we see that, of course, it has done since 1995 a lot better than the S&P 500. You can see the metrics over here with close to an 18% compounded annual growth rate. Maximum drawdown is quite large. I am generally not that worried about it. It's fairly easy to optimize systems and get drawdowns of 20-25% on your trend following. But I think eventually all those systems will get double the drawdown anyway in your live trading anyway. So I wouldn't be worried too much about that. Now, what you also see over here is that the last couple of years, it didn't do that great. And many times that is for many people difficult to continue to trade. Hence why I say, okay, it's important to trade many different systems because you then can combine a lot of different return streams at the same time and therefore lower the variability of returns. So we see over here basically that this year it's been up, but the years before it hasn't been doing that great. It is quite a wild system. I would not be able to trade this by itself, where you have months where it's 20% up and 20% down, but it fits incredibly well within a suite of non-correlated systems. So let's get to the rules of the system. So this is a monthly rotation system, and it's traded on the S&P 500. And the first thing we want to do is we want to have a filter in there that we say we only trade the stocks that are in the top 50% of the dollar volume. And although for most people, S&P 500 has enough volume already, I put that in there as well because I sometimes like to test back even further, back into the 70s. The volume itself, there's nothing special about it, this rule, but you just want to have enough liquidity. So we then see over here that we want to have enough volatility. So the historic volatility is over the last 250 52 days, so 1 year, is between 25 and 60. We want to have enough volatility in there. We also do not want it to be absolutely huge. And then we go to our next rule. We say, okay, the close of the S&P 500 index needs to be above the 200-day exponential moving average. So the index as a whole needs to be up. That's it. Then we get a lot of candidates, of course. And I like to keep things simple. So in this case, there's not even a trend filter in there. We can choose all kinds of things over here or pullbacks, etc. I've decided not to do that. And I just said, like, okay, the trend of the index must be up. And then we want to trade the stocks of the S&P 500. We want to trade the 10 stocks that have the highest rate of change over the last 200 trading days. And as far as position sizing, it's the same position sizing as I use in my book. We risk 2% per trade, and we max that out of 10% of our total equity, and we can trade a maximum of 10 positions, so that equals 100%. So you could trade this in an IRA account. So once we have selected the 10 stocks with the highest rate of change, we enter then over here, market on open the next day. So far, what we have is basically a system that says, okay, index must be up, and then we trade the stocks that have moved the most in a percentage over the last 200 trading days. And then we trade the top 10 stocks of them. We place a stop loss of 20%. So that is just to protect our equity. And then normally, for normal trend following systems, people can use trailing stops, or we can use all kinds of technical exits like Bollinger Band, moving average, or a 25% trailing stop, but nothing of that we do over here. And that's where it's exactly different. It is different because we do not use a conventional trailing stop. I have many systems that use conventional trailing stops, and all of those are down 20, 25% for this year. But the only thing we do is, so neither do we use volatility exits or profit targets, but every month, or in this case, every 20 trading days, we take a look if our positions are still in the top 10 of the stocks that have the highest 200-day highest rate of change. If they're still in that top 10, we keep those stocks in the portfolio. If they're not, we kick them out. And if the index is still up, then we replace them. So we rotate into a new stock, which at that time is in the top 10 of the highest rate of change. So in a recap, this system, what does it do? It looks that the index is up. Then it looks for the 10 stocks with the highest rate of change over the last 200 days. It places a 20% stop loss. And then every 20 trading days or every month, doesn't really matter that much. It then looks if it still applies, if it still is in the top 10 of the stocks with the highest rate of change. If not, it gets kicked out and something else gets put in, as long as it is above the 200-day exponential moving average. That's all. So the system is very simple and straightforward, and we can see very nice returns, normal drawdowns as well. Now, what's important as well is I'm a big fan of testing out of sample and going back a little bit further back to see how this would have done, not only from 1995 as we see over here, because of course there was a big bull market over there, but let's take a look if we would have tested this from 1975. Now, what we see is the compounded annual growth rate held up incredibly well, despite the fact that there was, of course, a big drawdown over here, which happens fairly suddenly. And when was that? Of course, the 1987 crash. It's not more than normal that a trend following system with a crash like that will make money. That's why I trade other systems that trade short at that time as well to counteract that, of course. But what you see is that eventually the compounded annual growth rate, if we go back 20 more years in sample, holds up incredibly well. So it is very robust as well. So I hope this video helped you a little bit to understand of how to think about systems. It's important that you take some action for yourself if you want to become successful as a trader. You can apply this concepts or some other concepts from the books that I've written. Also, we offer a mentoring program, and we also offer a live seminar. And for those last two things, for the mentoring and the live seminar, there's a link below this video. And if you're interested in that, you absolutely can sign up. So I wish everybody a great day and see you in the next video.